most European investors are quietly losing money every single year. Not because they picked bad ETFs, but because they picked the wrong type. The difference isn't exciting, it's not flashy, but over 20 or 30 years it can cost you tens of thousands of euros. Today, I'll show you the best accumulating ETF for European investors, why they usually beat distributing ETFs, and why I deliberately chose euro hedged versions, even though many investors think hedging is pointless. By the end of this video, you will know exactly which accumulating ETFs make sense for long-term wealth, and which mistakes to avoid because they quietly eat your returns away. I'm Daniel, a former London stockbroker and worked in finance for 10 plus years. I also publish stock market analysis to numerous investing websites, and in addition, I host one of the largest investor conferences every year in Central Europe. And if you want to see more videos like this, hit that subscribe button. Let's start with the basics, because this is where most people already go wrong. An accumulating ETF and a distributing ETF can track the exact same index. Same stocks, same performance, same risks. But they handle profits very differently. A distributing ETF pays out dividends to you in cash. You receive your money into your broker account. It feels good, it feels like income. An accumulating ETF does the opposite. It takes those dividends and automatically reinvests them back into the ETF for you. You never see the cash, but your share value grows faster. Here's the key point most beginners miss. Accumulating ETFs are not about income. They are about compounding. Imagine two investors. Both invest 10,000 euros into the same S&P 500 index. One uses distributing ETF. The other uses an accumulating ETF. The distributing investor receives dividends every single year, actually in every quarter. But those dividends are often taxed immediately, and unless they manually reinvest every single payment, part of that money just sits there doing nothing. The accumulating investor avoids that. Dividends are reinvested automatically. No friction, no timing mistakes. And in many European countries, often lower or delayed taxation, which is quite important. This is why accumulating ETFs are usually better for long-term investors who are still building wealth, not spending it. Distributing ETFs can make sense later in life, if you are living off your portfolio, if you want predictable income and optimized taxes. But if your goal is growth, accumulation usually wins, quietly, relentlessly, year after year. Now let's talk about something even more boring, but even more dangerous if ignored. The costs of ETFs. Every ETF has something called TER, the total expense ratio. This is the annual fee the ETF provider charges. And here's the trick. You never see it. It's deducted automatically every single day inside the ETF. You don't get an invoice. Your broker doesn't warn you. The performance just looks slightly worse. A TER of 0.07% sounds tiny. A TER of 0.40% sounds harmless. But over 25 years, that difference can mean tens of thousands of euros gone. Not to market crashes, not to bad timing, but to fees. High TERs slow down compounding. And compounding is the entire point of accumulating ETFs. This is why costs matter so much. When two ETFs track similar assets, the cheaper one usually wins in the long run. Not always in a single year, but over decades, almost always. Now let's get to the part that actually came for. First, CSPX. This is a USD denominated S&P 500 accumulating ETF. It gives you exposure to the 500 largest companies in the United States, Apple, Microsoft, Nvidia, and so on. The core engine of global equity growth. It's cheap, it's liquid, and actually is one of the most widely used S&P 500 ETFs in Europe. This is a pure growth ETF. No hedging, you fully accept USD exposure. Which brings us to the second ETF, SPPE, the euro hedged version of the S&P 500. Same companies, same index, but currency risk is reduced. Why would you choose this? Because currency can wipe out returns in the short or medium term. Let's say that if the dollar weakens significantly against the euro, your US stocks can go up, but your returns in euros go nowhere. Hedging eliminates most of this risk. I deliberately include euro hedged versions because many European investors underestimate how volatile currency can be, especially if your future expenses are in euros. For example, in 2025, the dollar declined more than 12% against the euro. At the beginning of the year, the euro dollar was trading at 1.04, and by the end of the year, it was trading at 1.17. So, if the S&P 500 moved up by 20% in dollar terms, but you invested in euros, your gain was only about 8% due to the currency fluctuations. Third, MWHE, an MSCI World Euro Hedged ETF. This is global diversification done properly. United States, Europe, Japan, developed markets worldwide. And again, hedged to euros. This ETF is actually quite boring, and that's exactly why it's powerful. It reduces single country risk, it reduces currency risk, and it lets global growth work quietly in the background. If someone told me they only wanted one equity ETF for the next 20 years, this would be very hard to beat. Now, let's add something different. IGLD, a euro hedged gold ETF. Now, gold doesn't produce cash, it doesn't grow earnings. And that's precisely why it belongs to this portfolio. Gold is insurance. During market crashes, inflation spikes, or geopolitical stress, gold often behaves differently from stocks. Not always, but often enough to matter. Hedging it to euros against removes unnecessary currency noise. You want gold exposure, not a USD bet layered on top, just a tiny bit of gold exposure. Finally, Xion, XCON. This one surprises people. Xion is a euro money market ETF. It tracks short-term interest rates. Why include this? Because sometimes the best investment is patience. Xion is place to park your cash, low volatility, daily liquidity, and returns that actually reflect ECB rates. Instead of letting cash rot in a zero interest account, this gives you flexibility, dry powder, and psychological comfort during volatile markets. Put together, these 5 ETFs cover growth, stability, diversification, inflation protection, and liquidity. They are accumulating, they are cost efficient, and they are designed for European investors who think in euros, spend in euros, and hopefully retire in euros. This is not about chasing the hottest ETF. It's about building a system that compounds quietly while you live your life. If you understand accumulating ETF, control costs, and manage currency risk intentionally, you're already ahead of most investors. And that edge compounds too. If you found this useful, subscribe to the channel, don't forget to hit the like button, and see you next time.